Welcome to this special edition of Taking Stock, where this week myself, Tim Lincoln, and our head of Stock Doctor Research, Kien Trinh, stream you all things share market. Welcome, Kien, and how are you?
Great to be here, Tim, and great to be here in the new financial year. It's going to be very interesting with the reporting season just around the corner.
Yeah, it flew by, didn't it? The financial year 24-25, and it was a remarkable one for equity markets, wasn't it? But more on that in a moment, Kien. And before we get stuck into the content, just a reminder of our that we are holders of a Australian Financial Services license and proud holders of that. So therefore, a quick disclaimer on all of the information we share today is of a general nature and should not be construed as personal advice. And all of the data, performance metrics, etc., that we also share, all of an historical nature, and therefore should not be relied upon as a guide for future performance. Well, Kien, it's been a very solid year for equity markets in 2024. The Australian share market up some 12.5%. That's the broader All Ordinaries Index, so a terrific year for compounding growth for Aussie investors. Meanwhile, across the shores in the US, the S&P 500 index up some 22%, Kien, almost 23%, with the NASDAQ up over 30% for the 12 months. So incredible. Meanwhile, the ASX Small Ords, and I also noticed the Russell 2000 in the US, down from those major indices. The Small Ords in Australia, some 9.3%, but more on that, the reasons for that in a minute. And therefore, breaking down that performance, it's really been a year of two halves, with the market experiencing a correction in the first half of last financial year. And but then immediately, almost during the December period and beyond, markets stage a remarkable relief rally, anticipating a soft landing regarding the economy. And further influencing, Kien, the strong momentum was firstly the euphoria around artificial intelligence, particularly in the US, but also flow-on effects here in the Aussie market, where investors just had this massive appetite for anything relating to AI, and that created a potential bubble that still continues to form. And secondly, large cap stocks really skewed the market by doing all of the heavy lifting due to the significant flow into market-weighted passive investment vehicles like ETFs, exchange-traded funds, which have artificially inflated, I believe, stock prices where they've got no regard to the fundamental quality of businesses. They just invest in everything relative to their market weight, the good, the bad, and the ugly. The elevated state of the market and dislocation between share prices and fundamentals, Kien, have been the key reason why we continue to neutralise portfolio risk across our Lincoln managed funds. This issue is most prominent in Australia, where corporate earnings expectations have moved lower since the start of the calendar year.
Yeah, that's right, Tim. And you can see this dislocation between earnings and expectations in black and the market index on screen in blue. And given that our star stock selection process, that's based on a lot of quantitative factors, Tim, it's interesting also to review the financial year through this lens. And the chart on screen really shows the performance of the various quantitative strategies over the year in the Australian market. And not surprisingly, as you've mentioned around the momentum and fear of missing out, and also ETFs, momentum strategies have been the driver of these returns. Meanwhile, though, and very interestingly as well, quality and dividend yield strategies have underperformed the market over the year to date. And given this, it's understandable, Tim, that our star income stocks, which is biased towards quality and yield, has underperformed the market over the year. It's because of the higher for longer interest rate environment that's put pressure on high yield stocks, which tend to be bond proxies like your REITs, utilities, and also your telcos.
Yeah, very interesting, Kien. All cyclical though, isn't it? All moving in cycles, of course. Meanwhile, despite our bias towards quality, Kien, our star growth stocks managed to perform on par with the market over the financial year, which is great. This has been quite incredible, considering that the portfolio has been significantly impacted by our exposures to the lithium theme, with stocks like Pilbara Minerals and Mineral Resources collapsing on fears of excess supply in the market. Investing in resources can be highly volatile because it's practically impossible to predict where commodity prices will go. However, excluding resources, our star growth stock portfolios have done well, as mentioned before, helped by strong performance in great stocks like Pro Medicus, RPM Global, Altium, Netwealth, and Hub24. Just a few stocks that come to mind, Kien.
And hopefully those stocks will continue to deliver for the next reporting season, Tim. But with core inflation currently at an annual rate of around 4.4%, and that's well above the RBA's target of 2 to 3%, the prospect for a higher for longer interest rate environment is inevitable. And this has not only led to a 42% rise in company insolvencies over the last year, but also impacted the earnings outlook for those large financially weak businesses, especially those on the ASX. And we've seen numerous large businesses release disappointing updates in recent months. And we've seen that through stocks like Star Entertainment Group, women's retailer City Chic, chemicals producer New Farms, global packaging firm Aurora, building materials, Fletcher Building, and property developer Lendlease. And we've talked about this numerous times over the last couple of months.
Yeah, you can't ignore the importance of financial health, can you, Kien? And there's some big names there. Just because you're big doesn't mean you're safe. And with the corporate earnings landscape looking vulnerable, especially across the consumer-driven sectors, it's important for you to prepare and reevaluate the stocks in your portfolio with reporting season around the corner.
Yeah, definitely, Tim. Focus on risk management and also limit or remove your exposure to those financially weak businesses. Meanwhile, you might want to take profits from companies that have rallied quite strongly leading into their results, because often you'll find that the high expectations have been priced in.
Yeah.
And the portfolio manager and the optimizer that we have, that makes this task quite easy by allowing you to sell and rebalance your stock holdings.
Yeah, the power of Stock Doctor, all of the tools required to really manage your portfolio proactively and keep it aligned to your objectives. In addition, Kien, you can build a list of potential opportunities that you can pick up over the reporting season by creating a watch list of stocks that are of interest. Monitor the stocks in your portfolio closely. Trading updates and earnings revisions provide some insight into whether a company is performing well for the financial year. So keeping a finger on the pulse all the time is really important. Positive earnings revisions reduce the potential for negative surprises over the reporting season.
Yeah, it's a very useful factor, isn't it? Earnings revisions, Tim. And
it is.
last but not least, set your alerts, ensuring that you are informed when there is a change to whether it be the financial health rating or the star stock change, or if the share price triggers an exit on the SD30 TSR, if you are trend sensitive, Tim.
Yeah, exactly, Kien. And from a portfolio strategy perspective, we want to reiterate the three main strategies that investors can employ. And we've really been emphasizing or encouraging the consideration of these strategies for quite a while now. For those who are comfortable with riding through the current market cycle, you can remain fully invested. That's 100% all in. But stick with, obviously, financially healthy stocks with solid fundamentals. So really following ideally our rules and our star stock universe and constructing portfolios of 15 plus stocks ideally, but you're all in the market. With this strategy, you need to obviously have a long-term horizon and be prepared to ride through significant market corrections.
Yeah, and the second strategy, Tim, involves having a cash allocation. So you may want to build up that cash level by taking profits on stocks that have rallied too quickly, for instance. And this cumulative cash allocation can help reduce the downside volatility of your portfolio and also allow you to take advantage of opportunities in the event of a market correction, especially if during reporting season, some of these stocks are sold down as well.
Yeah, volatility certainly does create opportunity, doesn't Kien? But you need to have some of those cash reserves ready for deployment in order to embrace the opportunity where quality stocks get oversold. And the third strategy, Kien, is to neutralize some of the portfolio's risk versus the market by buying a bear ETF like a BBOS. And BBOS are listed on the exchange. And if you type in the code BBOS, BBOZ into Stock Doctor, you'll see a classic strong bear ETF that can act as a hedge against market downturns. A bear ETF can be a smart move if you want to completely mitigate downside risk, and therefore you're worried about the current environment that could influence some sort of either a longer term bear environment where the market slowly trends down, or where a larger correction may be nigh. But on the flip side, if the market goes up, the bear ETF would lose value, which could offset the positive returns from your equities exposures. So yeah, if the market goes up, obviously the bear will go against you. If the market falls, that's where a hedging strategy can be of benefit if you're a bit nervous about the current environment. And now to Under the Microscope, Kien. And this week we want to take a look at how investors and members can identify oversold star stock opportunities in preparation for the upcoming reporting season. So let's dig a little bit into the system to help pick up some of these great opportunities that may exist. And the best way to do this is by using either the watch list or the stock filter. Select the category of star stocks or star income stocks, then sort in ascending order by, say, price to consensus targets. And that way it'll come up with a list of those stocks that are currently undervalued, Kien.
Yeah, that's right, Tim. But also here you need to be mindful of the active risk as well associated with the stock. And a great way to track this active risk is using that field again, the 3-month earnings revisions, because if that's quite negative, then you need to investigate the company further just to understand that. And within our star growth stock universe, for instance, some of the stocks with large negative earnings revisions have come from some of those resources like lithium miners, mineral resources, Pilbara Minerals, gold miner Alkane Resources, and oil producer Karoon Gas. But note that the earnings revisions for these stocks have been predominantly driven by falling commodity prices.
Yeah, and outside of the group just mentioned, Kien, some of our star stock opportunities include Hansen, Ridley Corp, Macmillan Shakespeare, ResMed, Endeavour Group, and Objective Corporation. So yeah, there's quite a few stocks there that are representing interesting opportunity, but I think it's really important too, Kien, that members don't just rely on the list. They must drill into each company to make sure that there's sufficient number of covering analysts and read our commentary to make sure they're making a fully informed decision on any stock.
Yeah, and talk to our analysts if you're a bit concerned. But similarly as well, within the star income stock universe, there could be oversold opportunities with Ridley Corp, Macmillan Shakespeare there as well, Charterhall Social Infrastructure, Spark New Zealand, Endeavour Group, Telstra, and APA Group, all trading at discount to their fair value as well. Again, investigate those companies to see and look at the yield as well.
Yeah, definitely, Kien. And within the watch list, then the filter, you can sort by star income stocks by the largest gross forecast dividend yield, or stocks with the closest ex-dividend date to help you prepare your portfolio for dividend payments following the reporting season. And now to question of the week, Kien. And given the new financial year, a question on everyone's lips is, do we have any interesting emerging opportunities for the year ahead? Or putting it another way, a few tips, Kien.
And that's a good question. And members can use our powerful Stock Doctor filter tool to look for those opportunities. However, the quickest way you can do this is by using your filter, Tim's growth or income stocks with potential.
Yeah, we find a lot of our future star stocks from these filters, don't we, Kien? So yeah, they are very, very powerful. However, you can't take every stock on the list for granted. You've also got to do your deep research to make sure that they meet your particular objectives and criteria, and that the fundamentals do really shine. So with these filters, you can sort by certain categories, including 3-month forecast earnings revisions, which is really powerful to see those stocks that have got really good, strong earnings revisions momentum into the future. Really important, great indicator, as I said. And also, we love founder-led businesses. So a way to find some of those founder-led businesses, they are few and far between, but they are there, is to sort by the CEO and chairman holdings column. And that will show you how much skin in the game the CEO and chairmans have.
Yeah, and as we speak, our research team is also currently reviewing some of these opportunities for potential inclusion, especially over the next reporting season. However, they'll have to look for an average daily trade above 200K because that's our requirement within Stock Doctor. But of course, Tim, the biggest question now is what stocks do you consider represent the exciting opportunities for the new financial year?
Yeah. So the ones that I currently like are Telix Pharmaceuticals. And we talk about these stocks a lot, don't we, Kien, in our investment committee meetings, and try to identify the ones that really do look like they're going to stack up from a fundamental perspective in the future. So we'd love to include them as star stocks. But yeah, some early opportunities. Telix, as I just said, one period of financial health. So it's a little early, but certainly they are on their way. A business, and they develop drugs to help treat prostate cancer. So very, very pertinent at the moment. Also, I believe Drone Shield has potential, a company that utilizes artificial intelligence. So it's in the AI theme, which is obviously, it's the trend at the moment. And they help the military and law enforcement through artificial intelligence and drones using AI. This business is expected to have 2 periods of strong financial health when it next reports. So perhaps they will be considered on their next report for star stock inclusion, but at the moment they only have one. So we need those 2 periods. Smart Parking is another one to consider, although its liquidity is low, an average daily trade of only 50K. So need to be really mindful of that. Remember, only have an exposure relative to how quickly you can get in and, more importantly, get out of stocks. So be very mindful of how much of a position you may take in Smart Parking. And meanwhile, on the larger cap side of things, I also like travel booking agency Webjet. I think there's still a bit of a contrarian play. Their fundamentals look great. Share price hasn't quite reached its all-time highs, although it has had a long run, but been in my filter now for many, many, many months. So hopefully our members picked up on it when it first popped into the filter, when price was a lot lower, but I still think there's opportunity there. But again, report not far away. Perhaps we wait until they do report to see if they consolidate their results, but numbers look great. And also mining conglomerate and construction and mining conglomerate Kien Group Holdings. Also, their numbers look pretty good as well. So yeah, there's a few there to consider. Telix, Drone Shield, Smart Parking, Webjet, and 7 Group. So I hope that guides our members into some more emerging type opportunities. But they don't need to be small to be emerging at the same time, as we've just highlighted. Well, Kien, that takes us to the end of another very special Taking Stock recording. The end of financial year is always a big time of year, and the new financial year is even bigger as we reset and off we go again. But it's always really important to keep our portfolios in tip-top shape, and also now getting ready to be very, very proactive as we enter reporting season. Also, a quick reminder that my quarterly message will be out in the next few weeks, so keep an eye out for that one, where I really dig a lot deeper into philosophical elements around the market at the moment and what we're thinking, and some tips and tricks for you all as well. So thanks a lot, Kien, for sharing your knowledge with us today. Most appreciated, mate.
Yeah, pleasure, Tim, and looking forward to bringing in some of those emerging opportunities into our portfolios in the near future.
All right. And thanks to all of our members for tuning in. We love sharing what we do with you, and most grateful for your loyalty and tuning in each week. Just a reminder too, Lincoln Live is on Monday morning. I won't be there. I'm away at the moment for another week or so, but Kien and the team will be there to entertain you in Lincoln Live. Okay, thanks everyone again. Have a happy, healthy and prosperous week.